Welcome back to another episode of Travis, Can I Have This? I am your host, Travis Slade. I don't think I've ever identified myself as a host before, but today we are going to talk about a tax that nobody told you about before you became a dental practice owner. I am a business owner myself, and being a business owner is really fun because you get a lot of surprises. There's a lot of bills that pop up on your desk that you were not expecting. And it's usually bigger bills, like we're talking thousands of dollars. And you get it on your desk and you're like, okay, what is this? Do I actually have to pay this? Is this fraud? Is this scam? What is going on? And you painfully learn about the cost of doing business. And there is a certain tax that without fail, every dental practice owner that I know that is in their first year of being a dental practice owner does not know this tax is coming. We're talking like average $2,000 to $6,000. So it's not like massive, but it's still not chump change. And it always surprises dentists. And for a good reason. Like, where else are you going to hear about this? Like, it's not an intuitive tax for most people. So it's not like something you're expecting. It's not something people talk about. So my goal today is we're going to talk about it to help educate the dental community on what this tax is. We have 3 goals today. First, I want to help you know that this tax exists. Then once you know it exists, and even if you're a practice owner and you do know it exists, what to expect, what actually happens, how is this filed? It's kind of a mess out there. So we got to talk about that. And then lastly, what can you do about it? What are some suggestions to reduce this tax as much as possible and to make it as painless as possible? So we're going to jump into it. Let's go. All right, if the suspense hasn't killed you yet, what is this tax? Well, I actually don't know what to call it because every state calls this tax something a little bit different. And this tax, though, is called by most states, I would say, or like a general term, is business personal property tax. And what we're referring to is all of the stuff that's in your dental office. We're talking your front desk, the cabinets, the countertops, the flooring, the waiting room chairs, the shag carpet, the beautiful mirrors and paintings you have on the wall, the dental chairs, who even cares about those, the delivery system, the sterilizer, the supplies in the drawers, the gloves, everything that's in your office except for the people that are in your office. We're talking small things, big things, all the things. There is a tax assessed on those items. And so the name business personal property tax is a common name. Also, some other names I hear out there are commercial personal property tax, tangible personal property tax, unsecured property tax. So like secured property is like real estate, land, and a building, like the external structure of a building. We're talking about unsecured property. That's like the stuff that's inside that really sometimes it's harder to remove, but really you could remove everything inside your office and make it just 4 walls and a dirt floor. Everything that is not the 4 walls and the dirt floor is considered unsecured property tax or business property taxes. So this is what we're talking about. There's this tax on all the stuff in your office. And the thing that makes this confusing is not every state has this. So this is a state by state thing, but most states do have this. So according to my research, now I don't have clients in all 50 states. I have clients in quite a bit of states. I worked in quite a bit of states, but not all 50. And so in my research, according to what I could find, there are 36 states that have this, which leaves, let's do the math there, 14 states that don't. And I will just list the states that don't. So if you're in one of these states, you just dip out of this episode and then text your buddies who are not in one of these states I'm about to list that they're suckers because they have to pay this. All right, if you live in Delaware, Hawaii, Illinois, Iowa, Minnesota, New Hampshire, New Jersey, New York, North Dakota, Ohio, Pennsylvania, South Dakota, or Wisconsin, you probably have no idea what I'm talking about because you don't pay this tax. Everyone else, you've learned the hard way what I'm talking about. I'll put on my podcast show notes and I'll put on my website my resource that I created to organize all 50 states. What it has is which states have this required, what the form number is that needs to be completed, what the percentage of tax is that you can expect, when the filing deadlines are, all of those things. I put it together using AI. So it has not been validated, but I did validate the handful of states that I know, and the information looked good on those states. So I haven't reviewed all 50 states, but I think it's a pretty good starting point to get your juices going if you're not sure if this applies to you or not. So check that out on my website if you want to know where to get going with figuring out this state. Okay, so this exists. This tax exists. Now, let's talk about what you should expect. How does this actually go down? How is it assessed? So we talked about how, first of all, it's assessed on everything that's in your office: dental chairs, dental equipment, leasehold improvements, supplies, furniture, the whole works. And we need to know the value of all of those things. And that's really the starting point for this tax. So if you did a startup and you recently renovated your office, it's pretty easy to figure out how much you paid for all that stuff. A, because you got a big loan for it, and the bank probably knows exactly how much you paid for it. But that's the starting point on all of the build out, all of the equipment. That is the value that they're going to start with. Now, if you bought an existing practice, and when you buy an existing practice, usually what you buy is the goodwill, that's going to be a little bit harder to determine starting point. In the allocation of the purchase price when you buy a practice, they do allocate a certain amount to equipment and other things, but ideally, you're buying old equipment. So you want to know the previous owner, what they paid for their equipment, and it does depreciate over time. So the value does go down over time, and you want to get their property tax statements that they filed the year before you purchased it and piggyback off of what they were sending for those forms. But you have to have a value for your equipment as a starting point. And then they have a tax rate that is assessed. And the thing that's really confusing about this is every state has a different approach to this. Obviously, some states don't even do this at all. But what happens, I would say, what I see with most states is the state will give the directive of what is going to happen, but it's executed at a local level, usually at a county level. So what will happen is your county will send you a notice to file this tax. And so you'll file it with the county, and the county will assess their rate, which even within a state, different counties could have different rates. It's possible all the counties have the same rate. It just depends on what state you're in. And that county then is who you pay the tax to. And I would say the lowest I see in my list is like 0.5%, so 0.5%. On the highest end, I've seen up to 4%, but I feel like the average is closer to 1%. So for example, if you have in your office leasehold improvements and equipment, and it adds up to about $500,000, you could expect to pay a $5,000 bill for this property tax. All right. Because this is administered by hundreds of different counties across the country, and every state has a different approach to this, they all also have their own deadlines. So when this needs to be filed differs for every state. Many states offer an extension, but that extension can be long or short depending on the state. I would say most states offer an automatic extension, but not every state does. So you have to be sure on if you're not going to file it on time when you need to extend it. And they all have different names for the forms that you fill out. So, for example, California, which I know really well, has a form that's called 571L. That's the form that you should expect to get in the mail from your county. It's due on April 1st of every year, but they give you an automatic extension all the way to May 7th of every year. So even though it's due April 1st and they'll have that due date on it, really you don't have to file it until May. Another thing is when you file the tax, sometimes it has to be paper, sometimes it can be online. Every state, again, is different. And also when you file it, you may or may not pay the tax at the time of filing. So we're all used to federal income tax. We all file a tax return for our income taxes every year with the IRS. And when we file our taxes, if we owe money, we have to pay the balance at that time. Otherwise, there's penalties and stuff assessed. For these property taxes, that's not necessarily the case. A lot of times you'll submit the form, the tax form, and then a couple months later, you'll get a bill in the mail from the county to pay that tax. So what happens a lot of times with these business owners is they file, like in California, they'll file the tax by May, and then they'll get a statement in the mail in August to pay $4,000 to their county, and they won't remember what it's for. Like, why do I owe $4,000? What is that all about? Well, it's for that form that was filed back in May. And so it can be just a very confusing thing, and it's different for every single location. Over the years, what'll happen is you'll get used to what it is for your location, for your city, your county, your state. You'll get the hang of it, and eventually you'll master this. But it's not because anybody really taught you. It's because you're going around the sun enough times to learn your lesson. All right, so now that we know it exists and how it goes down, let's talk about a couple tips on things that you can do. Now, there's not a lot of wiggle room. There's not like some advanced tax strategies that we're going to talk about, but there are a few things about staying organized and how that will actually help you pay a lower tax. Now, anytime anything flows through your practice, you want to make sure it gets organized and categorized correctly. Usually you should have a bookkeeper who's keeping track of your invoices. You want to make sure that the right stuff gets categorized toward equipment and the right stuff gets categorized to supplies. There are different rates often that are applied to those. You want to make sure you have clean, organized books on an ongoing basis. Now, the first thing that a lot of states have is they usually have an exemption amount. And you want to check with your state and see what their exemption amount is. Sometimes this exemption amount is $25,000, sometimes it's $250,000. And what this means is if the value of all of the equipment inside of your building is less than the exemption amount, usually you don't have to file this form or pay the tax. So you definitely want to know how much the value of your stuff in your practice is and what the exemption amount is in your state. And if you're below it, that's great. And you can avoid this tax entirely, even if you're in a state that applies it. Another tip is, we kind of mentioned this earlier, if you purchased a practice, it is in your absolute best interest to go to the previous business owner and get a copy of their asset list that they were sending to the county. So usually when people buy a dental practice, it's an asset purchase. So you literally bought the assets, the equipment, the dental chair, all of that stuff. And it got some weird lump value when you bought the practice. But now you actually want to know, what did the county think of that equipment? What did they value that equipment. Because what will happen is if you buy a new dental chair and you report it to the county, well, the county has their own depreciation schedule that's different than the IRS, and it's different than your state income tax. And they will typically depreciate that dental chair over time. So if you own that dental chair, you bought it for $10,000 and you own it for 10 years, after 10 years, or shorter usually, but just know after 10 years, that dental chair to the county has zero value. So you pay zero property tax on that dental chair. This works to your advantage. You want your stuff to depreciate on the county level so that you don't pay property taxes on it. And going to the previous owner and using their values and telling the county, hey, I bought the dental chair from this guy and it was a zero value to you and it's a zero value to me, right? And you want to try to do that as much as possible, which will save you money on taxes. You also want to update your asset list as often as possible. And when I say your asset list, probably the best starting point is when you file your business tax return, you have what's called a depreciation schedule. Your depreciation schedule is filed with the IRS and it lists all of your equipment. And you have to write off your expensive equipment gradually over time. But it's a nice list of all the equipment that you have in your office. And it's oftentimes used as a starting point when whoever is filing this property tax form at your local county. They will start with the income tax depreciation schedule and bring it over and start it. Now, what happens a lot of times is for the IRS purposes, you'll depreciate items and they'll go to a zero balance and they don't do you any good for taxes. And you just kind of leave it on your depreciation schedule for years. But sometimes you get rid of that stuff. And you might have gotten rid of some equipment, but it's still on the asset list. It's still on the depreciation schedule that's sent to the county. So you want to make sure that your depreciation schedules that are with the IRS and with the county, A, that they're the same, that they match up with each other, and B, that you remove the old items. If you have something on that asset list that you no longer have in your office, get rid of it because that will potentially save you money on these property taxes. The last tip I'm going to say is I would make sure to work with somebody who is familiar with these filings. Most accountants should be familiar, but you want to ask your accountant and make sure they are. Hey, are you familiar with business personal property tax that's filed at my state level and how to do that? Make sure they are and make sure that they are familiar with the deadlines and keep you compliant with all of these things. It's typically not an extremely difficult form to file. But as somebody who's an accountant who has filed these multiple states, I will say it always takes a couple of these to get in the groove, to get familiar with where the county wants certain things, how to report them, all that stuff. And then you get in a groove and you get it down. If it's the only one you're doing, you might miss something. So it's a good idea to hire someone, ideally you're an existing accountant, to help you file these forms. All right, that's all we got today. Hopefully you feel a little bit more educated on these personal property taxes. A lot of you have these due dates coming up. A lot of the due dates are in the beginning of the year. You can typically extend to later in the year. But make sure you don't forget about this, especially if you're in your first year of practice ownership. And if you're in the process of looking to buy a practice, make sure you check out our free resource to see if you're in a state that is going to have one of these taxes so that when you do buy a practice, A, you're not surprised, and B, you can ask for the previous owner's personal property tax as part of the closing process, because if you ask for it 6 months later, it's going to be a lot harder to get it. Okay, thanks everyone, and we'll see you next time.